Okay, fantastic. Okay, so we'll get started. All right, thank you so much, everybody. It's July 8th, 2010. This is going to be a joint FXDD, FX Street Forex training. Just to give you a quick disclaimer, we do not give buy, sell, or hold recommendations, and that trading is risky. You want to make sure you trade only with risk capital when you trade in the Forex, money that will not affect your lifestyle. Well, today is part 5. This is really exciting of our Anticipating the Forex Trend series. We're going to have Greg speaking about attributes of successful Forex traders, and this is a fantastic presentation. I think you're going to really get a lot of benefit. A lot of people in here today that are going to learn some great stuff. So, presenters, well, Greg Michalowski, he's our FXDD Vice President and Chief Currency and Trading Analyst at the company. Many of you have seen him speaking worldwide at one of his engagements. He also works very much so with FXDD on our commentary pages, and a great guy. You can get him on Twitter at twitter.com/GregMikeFX. I'm Sean Powell. I'll be co-hosting here, helping Greg along as he goes through his presentation. Now, FXDD, well, we are going into the next Formula One race. We sponsor the Red Bull team. If you recall, last week we were in Valencia, Spain, and so this week we are going to Silverstone in Britain. If the team gets a good bonus, you will get a good bonus too when you decide to open a trading account. All the details on that are at FXDD.com. And as well, we've got a trading contest going on right now where you can win 2 passes to a Red Bull team paddock at the next Formula One race. That also includes $5,000 for travel and accommodations. That is a great contest, very well received. You can get all the details on that at FXDD.com. Okay, so webinar housekeeping. Here's what we're going to do. We're going to teach you Forex market analysis, trading strategies, and about how to find opportunities for yourself. Participate. Make it great by asking questions in the live chat. I'll be answering those. We'll put questions through to Greg when he wants Q&A. And you can learn more about Greg at blogs.fxstreet.com/fxtrader-link. That's on FX Street. You can see all the details. Greg also posts on there on a regular basis. So very exciting stuff. So, Greg, if you're ready to get started, I'm going to mic out and pass you the camera. So good luck. Go ahead.
All right. Thank you, Sean, and thank you all for coming in here today. It's an honor to be here for the FX Street, I guess, free access day. It's good to have new customers come in and try out the service. And I speak not regularly, but about every 2 weeks or so, giving a webinar. And this is, as Sean mentioned, I think the fifth of the series, 4th or 5th. And it's really I'm kind of doing it a little bit backwards. I kind of put the horse in front of the cart, I think, in the first 3. And so I'm taking a little bit of a step back, talking about the attributes of successful traders. Nevertheless, it is something very, very important, and something that I see a lot of retail traders and new traders make the mistake of not building that foundation of being a successful trader. And not only that, they don't necessarily, or most people, a lot of retail traders don't know what it takes or what kind of attributes you do need to be a successful Forex trader. Ed, I was listening to Ed Ponzi earlier, and like I mentioned before going live here today, he's wonderful. And for those people who aren't familiar with him, get familiar with him, because he has a nice way of analyzing the market, and he's a wealth of knowledge and experience as well. But he was talking about it's not what you do, it's how you do it, and that's the key to being a success in trading, and successful traders all look at it. And he brought up, McDonald's may not have the best hamburgers, but they sure know how to sell them, and they do it time and time again. And we're going to touch on that's one of my attributes, more or less, in to be a successful trader. And he mentioned that good traders all follow this pattern, and I would have to agree. So we're going to go into those attributes, and I have 6 of them, and we'll go through them slowly, and we'll take a look at perhaps a few charts toward the end, or maybe within the presentation as well. We'll see how it goes. We'll take your questions. Sean, my partner, may moderate some of the questions. We do it a little bit differently than most people, in that I do have my partner Sean with us, so he may type some answers in on the chat window, and other ones he may funnel my way in a sort of answer question type of scenario. So the one thing where I want to start out with is actually before those attributes of a successful, before we get to those attributes of successful traders, and that is asking you all a question: do you have a mission statement for your trading? And this is the foundation. I mean, we're building the foundation, folks, of what you need to do to be successful, and the tools and the trading and how you do it, or what you do, as Ed said, that is really secondary to building this foundation, and the cornerstone of the foundation is a mission statement. And I ask this question a lot at a lot of my seminars, and I ask people to honestly raise their hand. Do you have a mission statement for your trading? And I tell you, 95% do not. They do not have a mission statement. And you out there may also, if you answer honestly to yourself, may not have that mission statement. But John preempted me because he's probably heard me, but because it's word for word here. My mission statement is this: to make the most amount of money with the least amount of risk. Make the most amount of money with the least amount of risk. And I appreciate John's comments. John, have you heard me before? I hope so, because that is, and if not, then I feel what I feel. I feel like I've made the right mission statement for myself without hearing to others. But you have to try to make the most amount of money. But the second half of that mission statement is always with the least amount of risk. Risk is an attribute or a thing that people, retail traders and traders in general, either those who are successful or those who are unsuccessful, those who are successful pay a lot of attention to risk, and those people who are unsuccessful tend not to pay a lot of attention to risk. And as far as making the most amount of money, does it mean that you're going to make $1 million? Does it mean that you're going to make 100,000? Does it mean you're going to take $1,000 account and make it 5,000 or 10,000? No, it doesn't. It's a relative term or a relative idea to the amount of knowledge you have, the amount of experience you have, the amount of the ability in order of you controlling your risk, and the amount in the way that you approach the market in your plan. All this goes into making the most amount of money, and it's not static. You today, as a trader, are at some point in your trading career. That is going to get better as time goes by. I hope, as long as you're able to control your risk. If you control your risk, you'll be able to stay in this game, and you'll find that to make the most amount of money that you make should increase as your experience increases. I've been doing this now for since 1983, and so that's a lot of years that I've been in the market, trading in one form of capacity. In the last 10 years, I've been trading or with the FXDD in the foreign exchange side, and I've seen a lot. And over that time, I've gotten better. I've developed a style. I've developed what I need to do in order to be successful. And I did not always have the attributes of what it takes to be a successful trader. So today, I'm going to put you ahead of the class. You're going to take a kind of ladders and slides and ladders, that old game when we were growing up, playing that game. I'm going to take you up a ladder that's going to get you to a new level here today. So the mission statement for all traders should be this: to make the most amount of money. Chutes and ladders. There you go. There you go. To make the most amount of money with the least amount of risk. So let's get into our 6 attributes of successful traders. And these I've developed again through the years, and I've found that, and I've learned by watching retail foreign exchange traders some of these things that you need to do in order to be successful as well. So the first attribute of successful traders is this: you need to have a skill or aptitude. You need to have a skill or aptitude. My wife is a CPA. She's an accountant. I took accounting in college way back when. I do not have the skill nor the aptitude to become an accountant. There are doctors out there who are listening today. There are lawyers out there. There are builders out there. There are skilled laborers out there who are listening here today who have a skill or aptitude that they've developed, and that they've had this ability that allows them to be successful in your skill that you do. And the same goes true for trading. This is not for everybody. You need a certain mentality. You need to be able to accept risk, to be able to control your things like fear and greed. And there are ways that you can control it, but you have to develop that through time. And some of you may have to look at yourself in the mirror at some point down the road and say, you know what? I can't become like I look myself in the mirror when I know I couldn't be an accountant, is that I can't become an accountant. And some of you may have to look yourself in the mirror and say, you know what? I just don't have the skill or the aptitude to become a trader. I can't take the risk. I can't take the fear. No matter what I do, I can't free myself of this fear, and I can't do it. And so it's okay for that to happen. I realize that there are a lot of people who think that it's easy to become a trader. It is not easy to become a successful trader. You have to work at it. This is not a hobby. This is not a 50-50 proposition that I think the market's going higher or lower. It is much more than that, and it'll take a certain level of skill, a certain level of aptitude in order for you to become successful as a trader. I use this one as number one, kind of to not to deflate you, not to make you think that it cannot be done. It can be done. You can develop your skills, but you have to want to do it. And if you have that desire to do it, you have that desire to get better. You can get better, but realize that it's still not for everybody. And I do not want you to go out there and lose your life savings because you have this feeling that this game is easy, and that you can make a lot of money trading foreign exchange. You have to work at it. It is a job. It is a business. You have to treat it like a business. The second attribute the second attribute of successful traders is this: the desire to practice. The desire to practice. But what I mean by practice is not necessarily opening a demo account and going in and trading during your free time and practicing that way. That is one form of practice, and I don't discount it. But a lot of times people will think that they have to have a little skin in the game. So there are ways that you can practice with a live account. There are ways that you can open up a micro account, for instance. A micro account has each value of a pip in the euro will be 10 cents, and that certainly is not. It's not going to put you. It's not going to ruin your lifestyle trading a micro account or a mini account whose value is $1 of a pip. You can do that as well. So that's a way that you can practice other than a demo account. The other way that you can practice, and I do this all the time, and it's what's really I've learned a lot from the market, is by watching the market. Just watch what the market is doing. Get in touch with the rhythm of the market. Listen to people like Ed Ponzi or myself, and see if you can develop the strategies that they use or that I use, and see if you can replicate, thinking of successful traders, and see if it really does apply, and that you have the confidence in what you're doing. Ed again, I refer to Ed again. I mean, he said that traders or McDonald's is, may not make the best hamburgers, but they make them. People like them and they replicate it over and over and over again. Good traders replicate their ideas over and over and over again. It doesn't have to be complicated. You don't have to make the best hamburger. You don't have to have tens or a number of indicators, or you just have to be confident in what you do, and the confidence comes from the practice, from how you view the market, and whether or not you can get in sync with the market and how the market is really moving. So you have to practice, and you have to spend hours of practicing and watching the market, developing the rhythm, understanding when it's good time to trade and when it's a bad time to trade. And all of that comes, if you can do that and spend the time practicing, you're going to become a successful trader. The third attribute of successful traders is, and this is where we get more into the risk side of it, is you need to evaluate and know your risk. You always need to evaluate and know your risk. I'm a golfer. I like to golf. When I go up to a hole and I stand there at the tee, I realize that the golf architect has a plan for that hole. He's designed that hole where there's risk generally on one side, and there's a lot of risk on one side, and there's an easy way, a way out on the other side. And I'll always steer clear of the risky side. Why? Because that's where I'm going to have the most trouble in the hole. If there's a traps on the left hand side and the right hand side is open, I'll try to steer clear of those traps on the left hand side and look down to the right hand side. So the same is true in trading. You need to know where the risks are in the trade, and you need to evaluate and know your risk. I like to tell traders that if you do not know your risk, if you do not specifically know what your risk is, then don't do the trade. Don't do the trade. And by that, I mean, I'm gonna turn this off a second here, the camera here, and I'm gonna go to my charts, and I'll bring that up and hit the camera here. Oops, hold on a second. Oops. There we go. All right, so you can see my chart here, and what I mean by evaluate the risk and know your risk is that you need to have a reason to do the trade, and if you have a reason to do a trade, then you know your risk. And the reasons can be varied. In this chart, looking at the euro, for instance, I simply have a trend line here that I drew in my chart here this morning, and this morning in my morning report, I said that there's a trend line resistance at the 127.05 level in the euro versus US dollar. I evaluated my risk. I knew my risk in doing a trade at this level right here. Because what is my risk? My risk is if the price goes above that trend line. That is my risk on this trade, is if I sell here against the 127.05, if the market goes 127.10 bid, I'm out. This is what I talk about as far as evaluating risk and knowing your risk. Just buying at the, even if you buy right here, or if you don't have a reason to buy, excuse me again, hold on. Get a drink. If you don't have a reason to buy, then you don't know your risk. Like, if you buy right here because the momentum's going higher, even though you may be right and the market does in fact go higher, you don't know your risk of this trade without having a line here at 126 or a reason for doing the trade. So as a trader, and successful traders will always have a reason to do a trade. And if you have a reason to do a trade, you also have evaluated your risk, and you know your risk. And if you know your risk, you feel much more comfortable with that trade, and you're able to execute the trade with confidence to sell against this trend line because it's there, and to know that your stop is at 127.10 on the trade, and now you can you're confident, and when the market comes back down to 126.71, you can have another reason why you know that's support or that's resistance. By the way, if I go to the daily chart, 126.71 was another key level in my chart going back to this high right here. Going back to May 21st, the high came in at 126.71. So on this corrective move to the downside here in the chart, we know that we have the risk going above that level. We also know we have support at 126.71, and the low at this period came in at 126.69, 126.70. So we are finding support there. So this is what I mean by evaluating risk and understanding your risk. Successful traders will understand that risk. They'll know their risk, and they will use that to their advantage. And if you don't know your risk, then don't do the trade, and simply wait until that time where you absolutely know your risk and you can evaluate it. There is one thing I tell traders that I can guarantee, and that guarantee is that you will always have another trading opportunity. And it doesn't matter. I can go through. I come into each day looking at the same charts that you do, and each of the day I see opportunity in the market using the tools that I use in my trading. And if I can do it every day, you can do it every day. And these are low risk trading opportunities where you know your risk and you evaluate your risk, and then you have the opportunity to profit from it. It doesn't mean that I'm going to be successful all the time. No, the market could easily have gone up above a 127.05 level to 127.10 in the example that I just showed. But the point is I knew my risk, and knowing your risk is the most important thing that you as a trader can do to make yourself more successful. If you don't know your risk, don't do the trade. It's as simple as that, folks. All right, the fourth attribute of successful traders, and basically it's kind of a extension of what we just went through, and that is to have and execute a plan. McDonald's executes their plan. They make their hamburgers the way they made it 20, 30, 40 years ago. It's the same recipe. They execute the plan and they do the plan with success. Does this mean in trading, you have to execute your plan, or you have to have a plan and you have to execute the plan as well, and you have to have confidence in that plan. You have to have confidence in your recipe that you're going to use to trade successfully. Does it necessarily mean that you're going to be successful all the time? No, we just went through that example. If the market breaks 127.10, we would have gotten stopped out. I would have gotten stopped out. I knew my risk. I knew my bias. I had an opportunity to sell against the 127.05 resistance level, and that's what I did. And if the market would have gone 10 did, guess what? I'm out. But it's better than losing 40, 50, 60 pips on a trade. I knew my risk. I limited my risk. I kept my risk to a minimum, and now I have the opportunity to profit from that trade. And I have an opportunity to profit. I can now put my stop at 127.05 or 10, or keep it there, or even at a lower level. And if the market breaks 71, I know the market's gonna, probably move further down in that direction to the downside. I know my risk. I have a plan. I've executed the plan, and this time, I'm successful in that plan. That's what trading's about. It's having a plan and executing the plan. And although we're not going to go through my entire, the plan that I have, that would take a while. And in fact, if you go back to the rebroadcasts of my first 3 or 4 webinars that I've done through FX Street, I actually touch on some of the the technicals and the tools that I use and how I look at the market In other words, my plan for trading. And I keep it simple. I keep things like I use things like moving averages. I use things like trend lines. I use things like Fibonacci retracement levels. Those are the three tools that I use, and I think that's enough for a trader. So my plan is to use those tools, and there are reasons why I use those tools. And as we continue on in my seminars and my educational seminars, we're going to be further exploring them. So we do hope that that you continue to listen to them, and not only that, you go back and listen to the rebroadcasts of these webinars, because they do provide that insight and that information to my plan that allows you to keep your risk to a minimum and make the most amount of money. So always have a plan and execute the plan. Believe in that plan. The fifth attribute of successful traders is the ability to control fear. Control fear. Now, this is one of those difficult things that a lot of traders have a problem doing. Let's face it. Fear and greed are what people often say are the killers of traders, is that they have too much fear, they have too much greed. So you have to find ways, and successful traders look for ways in order to control their fear. You can control your fear, folks. It does not have to be, you don't have to be fearful in your trading all the time. Is it good to have a little fear? Sure. And where should the most fear be? Right when you put that trade on, because you're right there at break even. You don't know which way it's going to go, or you do have an idea of which way it's going to go. Hopefully, you're confident in that idea, but you're still right at that break even point, and you're kind of, let's face it, hoping that it does what it should do. I have a rule that I tell my retail traders, and it's called the if-should rule. And the if-should rule says if you have a plan, and that plan is to sell against a moving average or a trend line, like we showed in the Eurodollar, because if the market approaches a trend line, the market should find resistance against that trend line, and it should go down. That's the if-should rule. If the market approaches a trend line, the market should find resistance to the trend line. If it does, it should go down. The dot of the if-should rule is that if it doesn't, get out. And so that's what trading is about. It's about finding those areas of that plan, executing that plan. And if you do that, if you have a plan, you're also able to better control your fear. And again, I'm going to go back to the chart here. I'm going to turn off the camera here for a second. I'm going to go back to my chart and turn on the camera again on my chart. Tell me if you can't, if this isn't controlling your fear. Selling against the 127.05 level here on the trend line here is a way that you can control your fear. Why? What should your fear be? Your fear is if the or what is your risk? Your risk is if the market goes to 127.10, 127.12. That's your risk. That in that case, the market would have broken through the trend line. So should your fear be dispersed? Sure. You're trading for a reason, and because you're trading with a reason, you're able to control your fear, and your fear becomes dispersed if you trade for a reason. So fear should not be a problem in your trading as long as you have a reason to do a trade and you execute the plan. And if you do that, your fear gets dispersed. It's like I like to say that it's like taking a quart of oil and pouring it in the Gulf of Mexico. That's not going to hurt the environment. I don't suggest that you do that, but you can see how the oil would be dispersed in this great body of water. Unfortunately, the situation that we have in the Gulf of Mexico is anything but that. There is no plan. There was no plan as far as a disaster plan, or if there was, it wasn't good enough. And that causes a great pit of fear now and also a great bit of damage. And I hate to use it necessarily as an example, but I think it proves the point that if you execute your plan and you understand your risk, you're able to control your fear, and your fear gets dispersed out over a great body of water, and you're able to accept that trade and use your stop levels, use your plan as your backboard, I guess, as something to lean against in order to improve your trading. And successful traders all do this. They're all able to control their fear, and the way that they control their fear is having a plan and controlling the risk. And once that's done, then they are they find much more success in their trading, and they'll find that their profits certainly show that. So that you need to be able to control your fear, and the way you control your fear is by having knowing your risk and executing your plan. The final attribute of successful traders, I'll put the camera on, thank you. The final attribute of successful traders is the other side of the fear and greed equation, and this is kind of ironic in that most people think that greed is bad for your trading. Actually, you need to have a certain amount of greed in your trading. Greed allows you to stay on a trend. Greed allows you to, if you stay on a trend, you're able to profit from the trends. And for those people who listen to my first 4 sessions, the way that you make the most amount of money is by being able to stay on the trends. You need to stay on the trends in order to make the most amount of money, which is the first part of our mission statement: make the most amount of money with the least amount of risk. So it is in order to be successful, you have to have some greed. You have to have the desire to stay with the trend as far as you can, and that requires, yes, having some greed. You have to stay with the position. And going back to the euro dollar example that we used this morning. Now, I don't know if the what the market's going to do into the afternoon. What I do know from our example was that we do have support at the 126.71 level, and I want you to just, rather than me put the chart up, I want you to remember what we saw when we were looking at that chart, and that is that there was support at the 126.71 level. Why? Because it was an old high going back to May. So from a trader's perspective, I have some choices here. I know that I sold at a good level. I have good trade location. That's number one. I don't have a lot of fear in the trade right now. Now, in order for me to be even more successful on this trade, I'm going to need that price to go through the 126.71 level. I'm going to need to see some momentum on a move below 126.71. Now it becomes, another question. Do I want to be a buyer against 126.71, or do I want to be more patient and have the greed and look for that move below the 126.71? And that really is up to each individual trader what you want to do. But let me pose this alternative, and what you can do is, if the market should approach 126.71, maybe comes down to 126.75 or 4, you have an option to take some profit at that level. You sold at 120, 702 or 3 or 4, somewhere around that area, maybe 127, and now the market comes down to 75. You have an option to buy some of your position back at that 75 level, or all the position back, and if it moves back higher and goes to the 127.05 level, you look like a hero. Now, what happens if the market goes through 126.71? You always have the option at that point to sell your position back out, to get short again. Why would you get short again? Well, because it's going back below that 126.71 level, which was the old high, which was resistance, which is now support, and if it goes through support, it should go lower, the old if should rule. So you can see how you can play these levels, but you also have to realize that, this could be the top in the euro. We went to a nice trend line. We went to a nice level where the market paused. It did the right thing from a technical perspective, and now we could see a rotation back down, which we could bring the market back down to even lower levels. And you as a trader want to have that greed. You want to take those times when you have good trade location, where you did the right thing, and you want to parlay that into a bigger gain, a gain that's really going to allow your account value to go higher. And these are the types of trades that you want to stay on, that you want to be greedy. I like to use an example to sort of really press the point, and that is of a pig farmer. Obviously, we know that bulls and bears make money, but pigs get slaughtered. We've all heard that saying before on as a trader, and it really that saying actually addresses greed, doesn't it? It says that you can make money being bullish, you can make money being bearish, but if you're greedy, if you're like a little piggy and you're greedy, you're going to lose money. Well, I don't necessarily agree to that. And I go back to even the pig farmer himself. What does he do? If he has a piglet in his pen, he's not going to slaughter it on that first day. He's going to allow that pig to get nice and big and fat. He's going to feed it and feed it good, and he's going to slaughter that pig when the pig can't get up and go to the trough and get its food. That's when the pig becomes becomes a negative to him as a pig farmer, and that's the point where he's going to slaughter the pig. Think of your account. You want to stay in the trade until as far as you can go until that point where the account is too large, where the account reaches its maximum level, and if you can do that and then slaughter the position or get out of the position at that point, that's when you become a more successful traders. And successful traders are constantly looking at those exits, what I call, along the highway, those next levels that they have to get to in order to say to themselves, all right, the pig's still getting fat. All right, my account's still getting fat. Let's see if we can go to the next level. So that's what you as a trader have to do, is have a reason to be greedy. And that gets to my final point here before I take any questions or I finish up for today. And that is, if you need a reason to get into a trade, if you evaluate your risk and you have a plan to get into your trade, you should also have a reason to get out of a trade. And if you don't have a reason to get out of a trade, don't do that trade. Look for a reason to get out of the trade. It'll make you a better trader. It'll also allow you to be greedy, to stay in that market, to have the pig get fatter and fatter. So here as we end, there is the euro's coming right back down to our support level here at the 71 level as we speak. I'm going to turn on the camera here back onto our charts. I'll be happy to take any questions in regard to the lesson here today, or to look at the market from a technical perspective, and I'll explain a little bit about my about the analysis, how I see the market currently at the moment. So any questions, shoot away, folks.
And Greg, we do have a question from John. He's asking if you ever move your stop loss to break even to eliminate risk and let the pigs get fatter, per se.
Right. Yes, you could. Managing a position, John, is about first getting in the position, and then you want to manage your profit. And think about that. You're managing your profit. That's a good thing, folks. Don't think about you have a profit in the trade. Now you want to manage that. Does it mean that you're going to get the whole move no, the market may rotate back to the upside, in which case you have to you're going to give up some of your profit. But if you think that the market has potential to move much lower, you're able to manage your profit by moving your stop loss down. Now, like I said earlier, you do have to have a reason to get into a trade and reason to get out of a trade. So in our example here, well, the hourly chart of the euro dollar, since that's one we're looking at here, the 87 level, that was our initial high for the day. That probably becomes my new stop level, loss level, if I want to take advantage of this move to the potential for a further move to the downside here. Why the 87 level? That was the initial high here. We paused at that level here. We broke above it here, came back down, and then moved to the upside here in this last moment. And then we start to use that level as resistance. Does that make sense as a reason, a level to get out of the trade? Sure, it's a reason to get out of the trade. Now, we just saw the market move below our 71 level and went to a low of 69 here. That equaled this low right here. That may be a reason to do a trade. It didn't do what it should do. I had the 71 level as my key level. Is it a reason to take some profit now? Yeah, well, we're back at 75. Maybe take half the profit, put the rest at 87. This is called managing your profit. The trade is still alive here. I'm a little disappointed that we went down to 71, but we did find support against that area. And trading, as we all know, is sometimes horseshoes and hand grenades. It's not necessarily right on the level. But what you have to do is take a look at what the price is telling you, take a look at the reaction of what the price is telling you, and make a conscientious effort. Should the market not get above this 87 level, I would think that the pressure would continue on the market, and the next level of target support would be the 126.60 level. That's a 100-bar moving average on this 5-minute chart. That's how I would analyze the market as we speak.
Okay, great.
Okay.
Thanks, Greg. Now, here's another good question, actually, and it's a technical analysis question from Bola. How early can we be spotting trend lines?
Well, as fast as you can draw two lines. A trend line is 2 points on a chart. So you connect 2 points, and you have a trend line, Bola. And in this case, we had a high here. We had a high here. This high went to lower levels. This high went to the lower levels. You put your trend line in, and then you can see here the market. It will tend to see that. The market is very simple. It sees lines. It sees support and resistance levels. It sees moving average levels. It knows these points, and it remembers them. And the market will, in a lot of instances, use those levels as a support or resistance, and you simply trade against them. And if you trade against them, you're keeping your risk to a minimum, and that's much better than just buying or selling for some unknown reason without a reason for doing the trade. So anytime you have a couple points along the line, within reason, put that in. The other thing I do warn against is all right, this move to the upside here. It doesn't make much sense for me to put a trend line from here to here. I mean, obviously that's too steep. That doesn't make sense to me. So I'll use some other indicator other than this trend line in order to evaluate this market. I'll look at Fibonacci lines. I'll look at the other target levels, moving averages, so on and so forth, in analyzing the market. I see an example.
Great. Actually, sorry, Greg, I was going to throw in, there's another addition to that question. In your experience, Greg, do trend lines work with all currency pairs or some better than others? And OSI will take your question next.
Okay. The answer to that is, Michael, is that what you try to do as a trader is to believe. Sean, if you can turn your mic off, that'd be great. It is that you're trying to find those areas which the market, which you believe in, and you believe that the market believes in as well. And by that, what I mean is that you have to have confidence in this trend line on this euro-dollar chart. And the fact that it worked here today doesn't necessarily mean that it's going to work all the time. But what it does, the most important thing that you as a trader have to realize is what it does is it allows you to be able to control your risk. And if you control your risk, you can control your fear. So by that, I mean that if you believe in this trend line, you can sell against it with little fear. You have little fear because you know where your stop loss is. And if you know where your stop loss is and you minimize your risk, then you're able to trade more successfully. Now, I just used the trend line as an example here today. As I mentioned, I do use things like moving average lines. I use things like Fibonacci retracement levels, and those go into my equation along with the trend line. And sometimes, a trend line and a moving average will converge, and so I'll use both of those in conjunction to have a multiple reason why I'm doing a trade. And sometimes I'll look for multiple reasons why before I even do a trade to make sure that I understand, I have more confidence in that trade. And that's another thing that you as a trader can do, is not just rely on trend lines, and I just use that as an example here today, but to kind of hone your skills and to use those tools that perhaps give you multiple reasons why you should do a trade, and then you have more confidence in that trade. So, will do trend lines work in euro yen and sterling yen? Yeah, they should. I mean, trend lines are easily visible by everyone out there. So I do think that they do work in all situations, but understand what the importance of it. And the importance of it is that it allows you to understand your risk and control your risk.
Okay, great, Greg. So the next question from OSI, actually there's a number of questions on the same topic, so I'll give you his first, is which time frames do you like to trade on, and do you use a multiple time frame strategy in your analysis?
The question is yes. I use the daily, I use the hourly, and I use a 5-minute chart in my analysis. And what I'm looking for in using all these, some people think that, one's longer term, the daily is a longer term, so you trade that from a longer perspective. Some people think that the hourly is intermediate term, and some people think that the 5-minute is shorter term when I want to intraday trade. That's not necessarily the case. What I'm looking for is clues from each of them to see if to find those areas that again are going to control my risk, that are going to increase my confidence, that are going to keep me to look at the market in the best possible way with the least amount of risk. So I mentioned, like in the daily chart, that I knew I have this 126.71 level as a key level in my daily chart. So, and I put a horizontal line there at 126.71. On the hourly chart, I'll put a horizontal line in at 126.71. And I can see here that the market on this day went up to a high of 126.61. On this day, it went up to a high of 126.64. And in my mind, I know I am, as a trader, I'm saying, well, it's because the market on the daily chart says 126.71. So the traders who are trading on this hourly chart know that the 126.71 is an important level, and now it becomes an important level on the hourly chart, and it's also an important level on the daily chart. And you can do the same thing in the 5-minute chart and see even more closely what the market did at that 126.71 level. We came up to the 60 level here. We came up to 61 level here, and each of the times could not push any more. Why? Because traders, early traders are in against that 71 level. It pushes down and comes down. Most come down to the 100-bar moving average. Here's another, this is an example of another line that I use. Look how it tracks the 100-bar moving average to the downside here. Track, break above, go to the 200, come back down, start to, these are the tools that I use. So, and then I'll have a line in at 126.71. So I look at all three chart time periods as one decision-making tool or one decision-making view of the market, and that's how I look at the market. I hope that answered your question appropriately. I see a question there. False signals using.
Absolutely, Greg.
Yeah.
Sorry, I was going to say great answer, Greg. Do you want me to pass you the next question?
Well, I'll take the question here because I don't want to just answer all the questions that are right. I see Bill's or that quote unquote make me look good, if you will. So Bill asked if there are a lot of false signals using this system, and Bill, obviously we are working in a trading environment here where this is the last question I know. Trading environment here where you don't know what may or may not happen. Obviously, there's risk in this in trading at all times. What I'm trying to teach is that there are certain levels in the market that I believe and I've followed and I watch, and certain tools that you can use that are followed by the market. I want to think like the market. And those tools that the market uses, I think, are because the Forex market is so huge, with thousands and thousands of traders, that that the market in general will pick out the most obvious ones, the simplest ones, the ones that you can actually see, the Fibonacci retracement levels that move from a low to a high, the trend lines, the moving averages, and I use simple moving averages, but as simple moving averages in my analysis, and I use 100 and a 200 bar moving average on, again, the 5 minute, the hour, and the daily. But I see that the market looks at the simplest things and makes their judgment from it. Will there be times where you get where you have false signals? Sure, but a lot of times those false signals actually give you a clue. For example, the 71 level here is a key level here in my chart. We went to 69. We went to 69. There's no momentum. It gave me, in theory, a false signal here. I did not get the momentum to the downside. Does that tell me something? Yeah, it tells me maybe I should take some of my profit here. If it gives you, on the trade, or maybe if I shorted 69, I better get out of that trade because it's not doing what it should do. Okay, it did not break below the 71 level. So that's about trading. But even false signals, I'm happy I get false signals because they tell me something about the market that I didn't know. It didn't do what it should do. So I usually exit those trades and look for the next opportunity. Maybe be a little bit more patient in the next trade. So that's my last question. I appreciate everybody coming in here today. I thank FX Street for what they do for the retail clients. Thank you, Sean. Thank you, everybody. If you have a question that I didn't get to, please email it to me at greg@fxdd.com. dd.com. There you go. Please, I would be happy to answer those questions. And I think I'm coming back on in another couple of weeks. So look for me to come on. I'm going to be talking a little bit about the game plan of trading at that point and continue the series. But thanks again. Thank you, Maud. Thank you, everybody at FX Street.